concerning deflation, not deflation from productivity, it means high-tech's been in deflation for decades.
Oh yeah, and that's a strong driver of deflation.
But you make the point that demand isn't going to keep up with production, but isn't in a free economy, if people don't see production, they're not going to produce?
Well, we do have a global economy, and a lot of this production increase is happening in other locales. Now what happened for decades was the U.S. consumer was driving not only the U.S. economy, in my judgment, but the world.
Right.
And the rest of the world was because of our ever-increasing trade deficit, which meant we were importing more than we were exporting, and the rest of the world was exporting more than it imported. And that, to me, is what drove China and most of the other Asian developing countries, and even Japan. Japan's been export-led traditionally. Well, if I'm right that the U.S. consumer is retrenching, trying to rebuild net worth, work down debt, and so on, will continue to increase its saving rate, then that means that this source of growth in the rest of the world is not going to be there. So what are they going to do? They still are export driven. I mean, China is trying to move toward a domestically oriented economy, but hey, consumer spending in China is 34% of GDP. It's 70% in this country. In Europe, it tends to be 58, 59%, the same even in Japan. I mean, China is so far behind on this, and I think they're moving that way, but that's a long-term project. In the meanwhile, they still depend on exports, plus their domestic stimulus, which they enacted in 2009, and now they're trying to go the other way. But I'm just saying, I think these countries are going to continue to be export-led, and they're going to push even harder on exports, because the U.S. consumer isn't going to be as cooperative. So that, to me, is going to be a big source of excess supply in the world, is this continual attempts of these developing countries to export their way out. And by the way, if you look at what's happening today on this export issue, without the U.S. consumer, how are these countries reacting? Unfortunately, they're reacting with protectionism. They're reacting with competitive devaluations. And I think if you cut through all that, although none of them say that, and I'm not even sure they think that, but I think that is a reaction to the removal of the U.S. consumer as this big buyer of first and last resort for the world's excess goods and services.
Grim picture. In terms of China, you're a bear, not a bull. Why?
Well,
precisely because they're too export-oriented?
Yeah, China is very export-oriented.
So you're not buying a Chinese ETF, right?
Yeah. China is very export-oriented, and they are. I think 2008 was a wake-up call for the Chinese leaders, because they had a marvelous machine going. It was driven by exports, and then they produced all the capital equipment and plant necessary to produce those exports. They had an inexhaustible supply of cheap labor, and they had good growth to accommodate all the people moving from the hinterland to the cities. Those people saved like crazy. The saving rate in China is almost 30%, if you can believe that. They put that money into the banks at very low interest rates, and then they turned around and lent that to the state-owned enterprises, and they were in effect arbitraging on these very low-cost funds, and kept a lot of inefficient enterprises in business. But it was a functioning deal. Well, I think 2008, with a recession and U.S. consumers retrenching, was a huge shock for the Chinese leadership, and they realized that they got to get going and work on a domestically driven economy, which I think they are, and they will. They're very smart, they're very determined people, but they got a long way to go. In the meanwhile, they've got a problem in that they stimulated the economy tremendously in 2009. Their stimulus program was 12% of GDP. Ours in 2009 was half of that, 6% of GDP. They got instant results, but they also got a property bubble, and they got inflation, and they're now trying to cool that off, and I think they may have a hard landing coming out of that.
In terms of where you put your money, even though treasuries have been battered recently, you'd still buy treasuries, and you would advocate buying zeros, which is has in effect even a higher yield than
oh yeah, it's more bang per buck.
More volatility, yeah.
Yeah, it's more bang per buck, but unfortunately it works both ways. If rates go up, you lose a lot more on zeros than coupon bonds.
So you'd buy treasuries. Other things you'd recommend? The dollar. You still like the dollar?
I do. I do. And it's not that we are doing as many things.
Gold says dollar sucks.
Well, it isn't
it's
that
the default currency.
I think to be candid, it's the dollar is the best of the bad lot.
Right.
And that's the argument. It isn't that we're really doing things in the way that you would advocate and I would advocate, but it's, and I think the Eurozone does have a lot of problems there. They'll probably keep it together, but you know, when they tried to jam the Teutonic North with the Club Med South, it was a noble experiment, but we're seeing that it's under real strain.
So in essence, when you look at the world, instead of going 80, we're going to go 40 for a while.